Joining us now to talk about this week's Fed meeting, former Fed Vice Chairman and CNBC contributor Roger Ferguson. Roger, good morning. Good to see you.
Good morning. Nice to be with you.
So, we mentioned, of course, no change is anticipated in terms of rates this week, though there seems to be maybe a call for a somewhat nuanced message from Chair Powell. You have to acknowledge lots of progress on inflation. Inflation's even lower than the Fed anticipated it might be at this point, and yet it's not at the target, so you leave the options open. What do you think is going to be the prevailing theme of Powell's remarks?
Well, I think the prevailing theme is going to be three things. One, the point that you've made, which is making good progress, but not yet done. So I think we'll continue to hear the question of, wanting to be convinced before completely moving in a different direction. Secondly, I think they're going to also indicate that when they move in a different direction, it will probably be further out than the market currently expects. And so this notion, I think they'll keep pushing back on this notion of, cuts in the first half of the year. And then finally, I think they'll point out that the recent data suggests that the economy, while slowing, is not falling off a cliff. It's handling higher interest rates reasonably well, which I think will give them the ability to continue to talk about higher for longer. So I think it's going to be a so far so good message, but with a pushback against expectations of a pivot to a cut early next year.
Yeah, and those expectations that are implied in the markets right now, I mean, they actually moved on Friday, it seemed, from the likelihood of a first rate cut going from March to May. And, of course, once you get several months out, this can swing around quite a bit on the data. I guess, how do you view that positioning in the market? It seems just kind of if we know they're done hiking and we know the next move is an ease, you're going to start to just sort of lay the bets and the probabilities and the hedges out there because a lot can happen between now and then, no matter what the Fed's intentions are.
No, I think that's right. I think you'll hear all sorts of rationale. There'll be some that look at history and say, on average, it's about 7 months or so from the end of a hiking cycle to the beginning of an easing. Every piece of data will support one part of the argument or the other. I think what people might be missing in the markets by being so focused on every piece of data is the Fed has got a strategy, and to date, I think they're probably feeling pretty good about their strategy. And so, I think in their heads, while they're data dependent, it's probably not going to swing as much as the market swings on every piece of data. I think the Fed's theme will remain the same for a period of time. And as they have been thus far, there'll be a consistency in trying to tell the markets, don't focus on every move and really don't even think about cutting rates until the second half of the year. So I think there'll be a little bit of a disconnect with the Fed staying where they are.
Hey, Roger, quick question for you. We once had Alan Greenspan tell us that the thing he watched the most was the 10-year yield. What piece of data do you watch most on the screen?
Look, right now, I think it is the 10-year yield because it is telling a combination of, the supply and demand story for sure. But what I found interesting is, the 10-year is also supposed to build in term premium inflation expectations. And it seems to be basically telling us probably the economy is in pretty good shape, but slowing and maybe slowing a bit more than the Fed is expecting. So I'd watch the 10-year, even though there are a lot of cross currents there right now as well.
But the yield, right? Not the price.
The yield. That's exactly right, Becky.
Roger, now, one reason that the market seems to have felt emboldened to start to project ahead to cuts is some of the commentary, right? I mean, we had Governor Waller say that, if inflation keeps going down, you would have the ability to cut the policy rate because you don't want to become incrementally tighter in real terms. And I guess there's also a general sense out there that the Fed may have concluded they don't really need to raise unemployment very much or cause a lot more economic restraint than they already are in order to achieve what they are in inflation. Now, we don't know if that's true, but does that seem to be the current thinking?
Well, if you listen to what Chair Powell has been saying throughout this entire episode, he has been talking much more around, the opening of jobs, the job openings coming down to better align with supply and demand in the market. So I think there is some truth to the fact that perhaps he is signaling that they don't really need to see the unemployment rate rise, dramatically to feel their job is done. I think vis-a-vis what Governor Waller had to say, people are ignoring the fact it's a conditional statement. If inflation slows, as we hope, perhaps we don't have to move more. People are also ignoring the other side that I've heard him say, and I think a couple of the other Reserve Bank presidents, which is if inflation looks like it's sticky, we are prepared to move higher. And I think the market tends to be ignoring that other conditional statement. So right now, I think the Fed is very much, as they're saying, in a wait-and-see mode, not ready. And I think Chair Powell said that's premature to even talk about cutting. The market's not hearing that, but I think that's really where the Fed is.
Yeah, I mean, the markets don't do well with no change expected, right? I mean, they want to look for the inflection point one way or another. But to your point, though, it's the inflation numbers themselves that seem to be, they'll dictate everything. In other words, if the inflation numbers are still going in the right direction, they're not necessarily going to have to look to influence other variables, as a kind of second derivative of the actual job, which is getting inflation down.
I think that's absolutely a fair point. And they say that very, very clearly. They are comfortable that things do seem moving in the right direction, but they always add the other caveat, which is it is still too high, right? So if you look at the average hourly earnings, it's not inflation directly, but one of the major influences. For the last 6 months, the average hourly earnings, if you annualize the number, has been increasing with a 4 handle, and that is not consistent with inflation coming in at 2%. So more recently, things have gotten a little better. But I think depending on how you look at it, the Fed is absolutely right to say, so far so good, but still a way to go, which I think at the end translates into higher for longer. And no, we're really not thinking about a pivot as quickly as the market would like for them to think about the pivot.
Yeah,
the other point, if I can continue with one other one, patience is important. One other point is they're not really sure what the so-called neutral rate is. And so I think they're going to be edging along a little bit here. And I think the market has gotten itself too excited about this move down when the Fed, I think, even its analytical framework is not consistent with a quick move down.